Welcome to the deep dive. Just the usual reminder before we start. This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflect knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend the listeners verify the information independently and consult with qualified professionals for personalized advice. Okay, so today we're taking a deep dive into a specific, timely source, a recent Luxembourg Intelligence News Briefing. It's packed with critical legal, financial, and regulatory updates. This is really a snapshot curated specifically for professionals like you do, in law, finance, corporate governance, compliance. Our source highlights a period of really intense activity, a lot of it driven by major new EU regulations like MiCA for crypto and DORA for digital resilience, plus key national stuff and deadlines. Our mission really is to unpack the most important nuggets of knowledge from this briefing for you, helping you get informed quickly on what really matters.
Absolutely. And you really do need to stay on top of these changes, especially in a place like Luxembourg. It's so central, isn't it? And what's really clear is how all these areas, tech, finance, corporate law, compliance, they're all getting more and more connected.
Okay, let's jump right into it then, starting with, how technology and regulatory expectations are shaping things. AI seems to be a pretty big focus for the authorities right now.
It absolutely is. The source highlights that the BCL and CSSF jointly published their second thematic report on AI use in finance just recently, May 16th, 2025. This follows up on their first study back in 2023, but this one really drills down into generative AI based on a survey they ran last summer, covered investment firms, fund managers, banks, payment institutions, the lot.
A second report already. That really does underscore the focus, doesn't it? What does a report like that signal for institutions actually using AI?
Well, it strongly suggests more specific guidance is coming. Maybe even, formal rules on AI governance, risk management, ethics, that sort of thing. The report itself mentions the EU AI Act, so you can bet future Luxembourg policies will line up with that. And the fact they got such a high response rate to the survey means the regulators have good data, they can be more nuanced, avoid really broad brush rules. Plus, the CSSF itself is looking into AI, like their Clarence initiative. That's bound to influence how they supervise. So for you, the takeaway is clear. Get proactive. Use this report almost like a benchmark. Start shaping your digital strategies, your governance, your internal policies now.
Right. And speaking of tech risks, cybersecurity, always a concern. The CSSF flagged something recently there too.
They did, yeah. On May 21st, 2025, they put out a communiqué about ongoing phishing campaigns, specifically targeting organizations using Microsoft 365, particularly those that haven't rolled out multi-factor authentication, MFA. They even pointed to a CERCL report with mitigation steps.
Okay, so not just a general heads up, but tied to a specific weakness in active attacks. How does this fit into the bigger picture, like DORA?
Oh, it's a direct link to DORA. Absolutely. I mean, phishing causes operational disruptions, data breaches, financial loss, all things DORA demands robust ICT risk management for. Incident reporting, too. So when the CSSF issues a warning like this, they expect institutions to act on it. Failing to implement basic stuff like MFA, well, that could look pretty bad during a DORA supervisory check.
Yeah, makes sense.
So it's a concrete reminder, really. Keep your cyber hygiene sharp, respond quickly to these alerts.
It's also helpful, I think, to just remember the sheer scale of the sector they're regulating here. That ALFI data gives some context.
It really does. The Association of the Luxembourg Fund Industry, ALFI, reported that end of February 2025, total assets in the Luxembourg global fund industry hit 7.567 trillion, and net assets in UCI specifically were 5.750 trillion at the end of March 25. Slightly down on the month before, but still.
Trillions.
Yeah.
It's a massive number.
Exactly. And that sheer size, that's why you see such intense regulatory focus. Look, implementing MiCA, DORA, all the AML updates, it's costly, it's complex for firms, no doubt. But the authorities see it as absolutely essential to safeguard what is, frankly, a systemically important sector for Europe and globally. That context helps explain the volume of rules we're seeing.
Okay, let's shift focus a bit and dive into the investment fund sector itself. Seems like it's navigating a huge wave of updates, MiCA being a big driver. The CSSF has been, busy.
Incredibly busy, yes. And what's really striking is the pace of MiCA implementation through these CSSF circulars. Just in late April and May, quite a few critical ones landed. So, for example, Circular 25891, that adopts ESMA guidelines on suitability and statements for crypto asset service providers, CASPs, who give advice or manage portfolios. Basically, it extends MiFID-like investor protection to crypto. CASPs need really solid processes now, client onboarding, suitability checks tailored to crypto risks, compliance statements.
Right, so proper investor protection comes to crypto.
Exactly. Then there's Circular 25886, adopting ESMA guidelines on classifying crypto assets as financial instruments. This uses a substance over form approach. Crucial. Prevents regulatory arbitrage, calling something crypto to avoid MiFID II when it really acts like a traditional instrument. Issuers, CASPs, they need thorough legal analysis here.
Right.
And for stablecoin issuers, asset-referenced tokens, e-money tokens, Circular 25885 adopts EBA guidelines on supervisory templates. This standardizes reporting, helps monitor financial stability risks. Issuers face pretty significant ongoing reporting duties now, need robust systems for that.
Wow, that's a lot of detail just on MiCA implementation. So it's not just getting a license, it's integrating this whole suite of operational requirements, investor protection, classification reporting. And you said the timelines were tight.
Very tight. The source highlights several other MiCA-related circulars in the same period: 25887 on reverse solicitation, 888 on transfer services, 889 on system security, 890 on classification templates. Most applicable from late April 2025. Circular 891 was May 25th.
Weeks, basically.
Exactly. The rapid succession really puts the pressure on firms. You need dedicated compliance resources, immediate reviews of policies, procedures, client agreements, disclosures. Across the board, it shows the Luxembourg crypto space is maturing fast under a demanding framework.
Okay. Moving beyond crypto, ESG fund names, there was a key deadline there recently too, wasn't there?
Yes, May 21st, 2025. That was the date. Existing funds using ESG or sustainability terms in their names had to be compliant with the ESMA guidelines by then. For new funds launched after November 21st, 2024, it applied immediately.
Why all the focus on just the name?
Well, it's a core part of tackling greenwashing. The idea is the name must accurately reflect the strategy and the actual ESG characteristics. Certain terms trigger specific requirements for quantifiable investment thresholds. It forces substance over marketing fluff, non-compliance, regulatory action, obviously, but also significant reputational damage. Firms had to ensure their portfolios genuinely align with the name, impacts prospectuses, kids, marketing, internal policies.
Right. And also on the practical side, a change for kids submissions.
Yes, the CSSF announced a new delegation management system for submitting key information documents, KIDs. That kicks in June 26, 2025. Key change. Delegations will now be to a legal entity sender, not an individual. And importantly, existing delegations expire on June 26th. It's about modernizing the process, should boost efficiency. There's even an API option for automation.
Okay, so firms need to adapt workflows and, crucially, get those new delegations set up before the deadline.
Precisely. Impacts internal procedures, agreements with service providers, all that.
And the CSSF keeps putting out guidance via FAQs, right? Always important to watch those.
Absolutely vital. In May 2025, they updated several key ones: AIFM Law FAQ version 24, the KIFAQ version 5, and the Cross-Border Distribution Notifications FAQ version 9. Look, FAQs aren't law, but they give you indispensable insight into the CSSF's interpretation, their practical expectations. Ignoring them is, well, risky from a supervisory view. The updated KIFAQ, for instance, clarifies filing requirements, which language version is the base for translations. Little details, but they can impact your internal processes.
Okay. And finally, on the fun side, data protection seems to be getting more spotlight.
Yeah, what's interesting here is the direct involvement of the CNPD, Luxembourg's Data Protection Authority. On May 20th, a CNPD rep spoke at an ALFI seminar specifically for conducting officers. It highlights the focus on data protection challenges in the fund industry. Funds handle huge amounts of personal data, right? Investors, beneficial owners for KYC/AML servicing. And the CNPD also recently updated its guidelines on international data transfers. So GDPR compliance, especially around data flows outside the EU, is a specific challenge here. Conducting officers are key in overseeing this. This hits things like data processing agreements with vendors, privacy notices, records of processing activities, those transfer impact assessments for third countries, policies, training.
Okay, let's shift now to corporate law. Big changes there for companies planning cross-border moves within the EU.
There are, yes. Driven by the law of February 17th, 2025. It transposed the EU Mobility Directive, came into force March 2nd, 2025, sets up a new legal framework for UE cross-border mergers, transformations, which includes moving a company's registered office, and demergers. And importantly, this new framework applies if your draft terms were published from April 1st, 2025 onwards.
So what are the main changes? What does this new framework actually do?
Well, the aim is more harmonization across the EU, but it also brings in new safeguards. This special regime, as they call it, is only for specific Luxembourg company types SA, SARL, SCA, moving within the EEA. Keeps flexibility for others. Key changes include a new anti-abuse control. The notary can actually refuse the pre-operation certificate if they suspect abuse. That's new. Enhanced shareholder rights, too. An exit right for dissenting minority shareholders for cash, and the right to challenge the share exchange ratio. Also, stronger creditor protection. They can seek court safeguards if their claims are threatened. And generally, more information needs to be published for stakeholders about their rights.
So streamlining mobility, maybe, but also adding layers of protection. Potentially more complex procedures, then.
Exactly that. For anyone dealing with these structures, it means really meticulous early planning, comprehensive documents. The notary as a gatekeeper is a big shift, and the potential for shareholders to exit or challenge creditors seeking safeguards. That could mean more legal challenges, more uncertainty, could impact valuations, need contingency planning for cash exits, disputes, require significant updates to draft terms, meeting docs, reports, notices, articles.
And in this whole landscape, directors' duties still absolutely central.
Always. Especially when structuring M&A through Lux vehicles, directors have to act neutrally in the company's best corporate interest. That means considering shareholders, yes, but also employees, creditors, the company as a whole. Good faith, prudent care, avoid conflicts.
And why is this principle particularly critical right now, do you think?
Well, it directly informs board decisions on major things like these cross-border moves under the new framework. And the idea that the duty is to the corporate interest, not just shareholder value, that's really key, especially in tricky situations like hostile bids, thorough documentation of board discussions, their reasoning, increasingly important. Showing why they believe an action is in the company's best overall interest.
Okay, switching gears again. AML CFT, always a high priority. The source details a pretty significant shift for unregulated AIF.
This is a major development, yes. On February 25th, 2025, the AED, that's the Administration de l'Enregistrement des Domaines et de la TVA, they supervise certain entities for AML, announced much bigger filing obligations. And this now covers all unregulated Luxembourg AIFs. Before, it was mainly RAFs, the Reserved Alternative Investment Funds. Now, all affected unregulated AIFs have to submit an annual AIF AML questionnaire and an annual RC report from their responsible du control.
Wow, that is a huge change for potentially thousands of structures. What are the deadlines for these new filings?
It is a big expansion, yeah. And the deadlines for the 2024 financial year, they're coming up fast. May 31st, 2025 for RAFs, and June 30th, 2025 for other unregulated AIFs. Think certain LPs, so RFIs acting as AIFs.
Okay, so what's the core message here for these funds and the people who service them? What does it all mean?
Well, the key thing is it closes a supervisory gap. It brings these previously unregulated AIFs under much more formal AML-CFT reporting scrutiny, closer to what CSSF supervised funds face. The AED has explicitly said they're stepping up enforcement this year. Non-compliance could mean penalties. The questionnaire now covers terrorist financing, and the RC report gives the AED way more insight into the AIF AML activities. So for you, if you're involved with these AIFs, it's urgent. You need to establish or seriously enhance your AML frameworks. Formally appoint an RR, responsible due respect, and an RC. Conduct documented risk assessments specific to each AIF. And prepare these annual filings. It's going to be particularly tough for smaller AIFs without big compliance teams, requires massive documentation updates, policies, procedures, risk assessments, appointments, and the filings themselves.
And the CSSF is also busy keeping Luxembourg aligned with EU AML standards.
They are. On April 8th, 2025, they issued circulars adopting key EBA guidelines. Circular 25878 adopts the revised EBA guidelines on MLTF risk factors, and Circular 25879 adopts the EBA travel rule guidelines for funds and crypto asset transfers.
Ah, right, the travel rule. That definitely connects back to the crypto sector we talked about earlier.
It absolutely does. It puts new obligations on CASPs collect and send specific data about the sender and receiver of crypto transfers. But for all financial institutions, these circulars mean you need to review and update your MLTF risk assessments and controls to match these revised EBA guidelines. For CNSP specifically, the travel rule means significant new operational burdens. new procedures needed. Impacts AML policies, travel rule procedures, risk assessments, training.
Okay. Moving over to the banking sector, there was a pretty landmark court case recently.
Yes, very significant. On May 22nd, 2025, the Luxembourg District Court actually convicted the private bank Edmond de Rothschild, Europe SA, for money laundering. This was linked to the 1MDB scandal, and the penalty was a $25 million confiscation.
And the source says that's reportedly the first criminal conviction for money laundering of a bank in Luxembourg.
That's what's reported, yes. And that makes it, well, a very stark reminder of how seriously the authorities are taking AML failings, even historical ones. Look, $25 million is a lot, but the reputational hit for a bank is arguably even bigger. The clear message from this case: robust, effective, constantly reviewed AML controls are critical. Severe penalties, even criminal liability for the institution, are possible. It doesn't directly trigger doc changes for others, but it powerfully underlines the need for effective controls.
And DORA continues to drive updates across the board for financial entities.
It does. Applicable since January 17th, 2025, and the CSSF is issuing specifics. Circular CSSF 25880 from April 9th is for payment service providers, PSPS. It transposes new EBA guidelines, mainly on managing relationships with users, but crucially, it also integrates that national annual PSP ICT assessment requirement that's due March 31st via eDesk for the previous year, so it streamlines ICT risk rules for PSPs under DORA. PSPs need to update policies, reference this circular, and make sure they hit that annual assessment deadline. Impacts ICT risk policies, user procedures, assessment frameworks.
And for all DORA entities, there are specifics on using third-party services, especially cloud.
Yes, Circular CSSF 258882, also April 9th, applies to all DORA entities. It digs crucial Luxembourg context for using ICT third parties, especially cloud. It recalls DORA rules but adds national specifics, particularly around professional secrecy. Mandates that any access to professionally secret data by a third party must strictly comply with Luxembourg laws like the LFS or LPS. And here's a big new governance requirement: mandatory designation of a cloud officer, someone responsible for overseeing cloud use and staff competence. The circular also clarifies that a service provider doing the resource operation for cloud in Luxembourg might need authorization as a support PSF.
Okay, so it's not just general DORA outsourcing rules. Firms need to navigate that specific Luxembourg professional secrecy angle and create this new internal role. What does that mean practically?
It means your third-party deals, especially cloud, have to comply with DORA and these CSSF clarifications. That professional secrecy link is key. Impacts outsourcing agreements, due diligence, internal governance, including formally setting up and resourcing that cloud officer role. And you still have that ongoing DORA obligation to maintain your register of ICT third-party arrangements.
Right, the register.
And speaking of that register, the CSSF actually extended the deadline for corrected submissions via eDesk to May 31st, 2025. And helpfully, on May 16th, they published guidance explaining common error messages, gives firms more time and help for this complex new report, which the CSSF will clearly use for supervision.
And for investment firms specifically, remuneration policies are also getting an update.
Yes. Circular CSSF 25884, published April 16th for investment firms. It adopts the latest EBA guidelines on sound remuneration policies under IFDIFR. Also clarifies things specifically for small and non-interconnected firms, SNIs. The goal is ensuring pay practices don't encourage excessive risk-taking and rules are proportionate. So investment firms need to update their policies, procedures, paying close attention to the SNI specifics. Impacts remuneration policies, committee mandates, maybe employment contracts for identified staff.
Just a quick note on the EU court side, relevant for banks.
Yeah, a CJ EU judgment, May 22nd, 2025, in the Trasta Commerzbank case. It involved an appeal against the ECB withdrawing a bank's license. Significant because it's the EU's top court scrutinizing how the ECB uses its supervisory powers within the single supervisory mechanism, especially for something as serious as license withdrawal. The reasoning will be important for understanding the scope of ECB powers and bank rights.
Okay. And finally, for banks, upcoming transparency requirements.
Banks should be gearing up for enhanced public disclosures under Pillar 3 due to CRR3 changes. Updated EBA standards have initial reference dates, March 2025 for traditional risks and June 2025 for ESG risks disclosures. It's a clear move towards more granular reporting, especially on ESG risks and their potential materiality. Banks need to get internal systems, data collection, reporting frameworks ready.
All right, let's shift gears completely now and touch on some key tax updates for 2025. We'll explain these for folks who aren't tax specialists but need to grasp the impact, starting with corporate income tax rates.
Yes, okay. So from the 2025 tax year, Luxembourg has slightly reduced its CI2 rates. This was based on a law from late 2024. For companies with taxable income over 200,000, the main rate drops from 17% to 16%. And for income up to 175,000, it goes from 15% down to 14%.
Okay, small percentage change, but what does that actually mean in practice for companies?
Well, for profitable firms, especially bigger ones, it's a real, though modest, reduction in their tax bill. When you factor in the solidarity surcharge and municipal business tax, which varies a bit by location, the overall effective rate for a company in Luxembourg City, for example, is estimated to drop from about 24.94% down to 23.87%. It's clearly aimed at boosting Luxembourg's competitiveness.
And there's also a simplification for the minimum net wealth tax.
That's right, also from the 2025 fiscal year. The minimum NWT calculation gets simpler. It'll just be based purely on the company's total balance sheet value. There's a scale of fixed minimum tax amounts from 535 up to 4,815, replaces a more complex system, should be simpler and maybe fairer for smaller balance sheets.
What about subscription tax, particularly for funds?
Two things to note there. First, from January 2025, the subscription tax exemption got extended to actively managed UCI's ETFs. Before, it was mainly passive ETFs, so this makes Luxembourg more competitive for a broader range of ETFs.
Okay, that's helpful.
Second, for SPFs, the Sociétés de Patrimoine Familial, the minimum annual subscription tax has jumped significantly, from €100 up to 1,000. That's from the 2025 tax year. The rate is still 0.25% on a specific base, capped at €125K, but the floor is much higher. And they've introduced new penalties, up to €5,000 a month for not complying with the SPF law.
Oof, quite a jump there for the minimum SPF tax. Why the increase? What's the thinking?
Well, the stated aim is to ensure SPFs are used correctly for private wealth management as intended and maybe curb potential misuse, tightening things up.
Got it. Any other key tax changes for 2025 worth flagging for our listeners?
Yeah, a few others highlighted. There's clarification on the tax treatment for redeeming a whole share class. It can qualify as a partial liquidation and potentially avoid dividend withholding tax if conditions are met, provides more certainty there. Also, from 2025, corporate taxpayers can choose to waive the participation exemption on qualifying dividends or capital gains. Adds flexibility. Might be relevant for groups under Pillar 2 rules, maybe. And finally, mandatory e-filing for withholding tax returns on directors' fees and wages starts in 2025, just part of the ongoing digitalization push.
Right. And speaking of Pillar 2, that's obviously a massive global change affecting large groups.
Huge. And Luxembourg has transposed the EU directive into its law. It implements the OECD's Pillar 2 rules, designed to make sure large multinational and domestic groups, those with consolidated revenue over 750 million SUs, pay at least a 15% effective tax rate globally. The main rules, the Income Inclusion Rule, IIR, and the Qualified Domestic Minimum Top-Up Tax, QDMTT, generally apply from fiscal years starting December 1st, 2023. The Undertaxed Profit Rule, UTPR, kicks in a year later.
So for these really big groups, Luxembourg might end up collecting top-up tax if their profits elsewhere are taxed below 15%.
In essence, yes, though the rules are incredibly complex and really only impact the very largest groups. But what this whole array of tax measures shows is Luxembourg balancing things, right? Enhancing attractiveness like the CIT cut, the active ETF exemption, but also implementing international obligations like Pillar 2 and simplifying some bits while tightening others like minimum NWT and the SPF rules. Companies definitely need to reassess their positions.
Okay, as we start to wrap up this deep dive, let's look at some key deadlines and chances for industry input that the briefing flagged.
Yeah, the source has a useful summary table, and what really jumps out is this cluster of compliance deadlines in late May and June 2025. We're just past that May 21st deadline for existing funds on the ESMA fund names guidelines. Coming up fast, May 26th for the MICAR supervisory templates to apply, and May 25th for the MICA suitability and portfolio management rules.
And some important reporting deadlines right around the corner, too.
Yes, for DORA entities, the extended deadline for corrected DORA registers via eDesk is May 31st. And for those unregulated AIFs, the new AED AML CFT reporting deadline for the 2024 year, May 31st for RAFs, June 30th for the others.
Plus that practical operational change for the KID submission.
Right, don't forget that. The new CSSF KIDI delegation management system goes live June 26th. Old delegations stop working then. Need the new ones set up.
And opportunities to actually provide feedback on future rules.
Absolutely. ESMA has consultations open right now if you want to have your say. Deadline for comments on technical standards for the European Green Bond regulation is May 30th, 2025. And for technical standards on the ESG rating activities regulation, it's June 20th, 2025.
Okay, and a prudential reporting reference date later in the year.
Yes. For banks, that first reference date for the new EBA Pillar 3 disclosures on ESG risks under CRR3 is June 2025. Actual reporting is later, but the clock starts ticking then. Managing this concentration of deadlines while also trying to engage strategically on future rules definitely requires careful planning and resource allocation.
So when you pull it all together, what does this all mean? We've covered tech, AI, funds, crypto, ESG, corporate restructurings, AML, banking drawer, tax. It's a vast, interconnected picture.
It really is. And what's compelling is, as we said at the start, how interconnected it all is. These aren't silos. Regulations like DORA, MICA, they don't just sit in one box. They converge with AML rules. They impact governance, data handling, even tax sometimes. Affects everything from IT to board decisions.
Which really brings us to the core challenge, doesn't it?
Exactly. How do firms move beyond just ticking the box on each individual rule? How do you build genuinely resilient, genuinely compliant frameworks that can actually adapt to this integrated, fast-moving environment? That Edmund Rothschild case we talked about, it's a powerful reminder, isn't it? Failing to manage these interconnected risks can have really severe, concrete consequences, way beyond just a fine. So the question for you is, how are you ensuring your firm isn't just keeping pace, but is truly equipped to navigate this complex, dynamic landscape proactively? And just the final reminder, this podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice.
Hit that like and subscribe button. It was the Luxembourg Intelligence News Briefing podcast for you today.